Welcome to the Lynette Zang YouTube channel, where we support community and sound money globally. Now, we're really working hard to boost this channel and get a lot of subscribers so that we can get even more subscribers. So the best way to help us do this, and I appreciate you doing it so much, is to hit that subscribe button below. And on the way in of viewing this video, please give us a thumbs up right then so you don't have to think about it on your way out. Leave us a comment. Please help us grow this channel. It's critical. And today, this is so critical that I actually had something else planned for today, but I had to talk about this because I'm always talking about pattern shifts and how when you see a pattern shift, you don't even have to understand what it's about, but what you need to understand is that things are changing to the good or to the bad, and we'll talk about where we're at with it. But whenever you notice any kind of pattern shift, you gotta pay attention because it's basically telling you that there is an evolution that is happening. And you want to be prepared for it because all of this Jenga economy, at the end of the day, if you are not prepared, then you're really going to suffer a lot and your family's going to suffer. And I just don't want to see that happen to you. So let's just jump right into it. Because the first thing that I have to show you is what's happening in the markets and this huge shift. This is so big, okay? So what do we know? We know that what you're looking at is the Federal Reserve balance sheet, the blue line is the Fed balance sheet, and the red line is the S&P 500. And you can see how since 2008, they kind of were working much in tandem. But there is now this major shift that's happening. Could it be like it is over here? Maybe, but I don't think so. I think this is much bigger because there is a decoupling that I'm watching in the global central banks' behavior with interest rates. Some are raising them, some are lowering them. And so we've got some things coming up with that. And I think this might have something to do with it. So just so long as you're aware that how synchronized this was starting in 2009, in 2023, that started to shift. And here we are. This is the end of 2023. But hey, stock surge, even as blowout jobs report, which was shocking to many, pushes some Fed officials to consider another rate hike. So we've been wondering, when are they going to lower the rates? When are they going to do the pivot? But inflation and the job market is proving stickier than what they anticipated. Part of that, and we're going to talk more about this, but part of that is because the central banks, it's not really a tight credit market. So that didn't really happen. But what is happening is this is the very end of the currency's life cycle. So whenever you hear them say, wow, that's so unusual. Oh, that's so unusual. It's because of where we are in this trend cycle. While it is not my baseline outlook, I continue to see the risk that at a future meeting, we may need to increase the policy rate further should progress on inflation stall or even reverse. And let me tell you, if they're talking about this, it's because they are seeing it reverse. And I'm seeing it reverse, right? We are not done, and they can't fight the inflation because that genie is already out of the bottle. How they put it back in, they can't. Once it's out, and we are in deep trouble. But what this is indicating, which is another shift, though this is one that happened, June of 2022, is that the markets no longer trust the Fed and they're fighting it. So the Fed says, well, we might even raise rates, which would not be good for stocks because they need more debt, right, to keep buying their stock certificates and support the stock market. Markets are now fighting the Fed outright. They don't believe them. This is dangerous. How dangerous is the debt wall if rates go up and they have to refinance that debt in higher interest rates? Well, let's see. we are about to see how big the zombie corporations are, because we definitely do know that interest rates and the markets, it's going to have an impact on the bond market, the stock market, and the debt market is the biggest market of them all, especially since this stuff is based on debt and the ability to grow more debt. So let me tell you, if you don't see the danger, I hope you see it after this, because here is another disconnect between Fed funds futures and the S&P 500. And the stocks have brushed off the repricing of rate cut expectations as, oh, are they going to do 2? Are they going to do 3? Hey, they might actually be raising the rates. Ultimately, they are going to drop them again and start with their money printing machines because they don't have any other tools. But this is such a big deal. And that just happened. That just started the decoupling in January. So like the chart that I showed you in the beginning, Fed funds futures, so that's the interest rates, and the S&P 500. Here it was correlated. It's been correlated since the Fed said, we'll let you know forward guidance. We'll let you know what we're going to do so Wall Street can get into position to take advantage of it. Well, pay attention to this pattern shift because it is breaking down and it is showing you that this system is breaking down, no longer correlated. I thought it would be hard for the market to challenge the Fed on the hawkish side, but apparently it is willing to do so. So I'm trying to show you that we saw that the markets lost confidence in the Fed in June of 2022. They are fighting the Fed now. And guess what? With all their derivatives and all their shenanigans, can they overwhelm the Fed's ability to print our way out of it? I think they can. Because at last count, before they changed the way that they accounted for it, there were, and I saw it with my own eyes, so I'll say it, 1.4 quadrillion in these big bets, these derivative markets. And that's only the market value. That does not indicate the true value at risk. So these pattern shifts are going to impact everybody. I don't care who you are. That's why it's so important. If you were thinking about doing it, get it done. It's critical. Because the treasuries, which is the foundation of the global markets, what's been happening in the treasury market? Interest rates have been going up. The treasuries have been selling off. It's a big problem. You don't want to be caught in it. A rough start to the year for bond traders worsened Friday as data showed a buoyant U.S. labor market with few of the stresses that could prompt the Federal Reserve to lower interest rates. So why is the market buoyant if the Fed's been tightening? Because financial conditions have not really been tightening. They're talking out of both sides of their mouths. This data certainly doesn't give the Fed the impetus to cut anytime soon. Treasury yields are poised to continue to move higher. The strong data and rising oil prices likely mean the 10-year yield is headed to crack 4.5 to 4.6. There are so many of these bets that's based on those interest rates, and nobody really knows, and it's a very opaque market. Nobody really knows what level is going to overwhelm that market because that bubble has already been popped. Now, they are trying to control it, and I don't know, are they being successful? We are going to find out, but you don't want your wealth to be the cost. That's why it is critically important that you have assets and wealth outside of the fiat money system. What does this do to the bank vulnerabilities in gold? Because remember, with rising interest rates, right, the market value of all the debt that these banks are holding goes down. So now where they were talking about lowering interest rates, is there the possibility that they're going to raise them because inflation with oil prices above $90 a barrel, right? We're going to notice that at the gas pumps. And that's going to have an impact on inflation. And so is the strong labor market. Although I think in 2025 or maybe the rest of this year, we're going to see a lot more layoffs. So I think that's shifting. However, what this does is make the banks a whole lot more vulnerable. And you don't want them to be vulnerable because that's the tool that the central banks use to push their policy out to the normal population. So let's take a look at what's been happening with gold, because gold has broken that top, as we've talked about. Now remember, this is just the spot gold market. Breakout was actually September back in 2021, right? From a high that it was created back in 2013. But then they suppressed it, they pushed it down, they pushed it down, they pushed it down until they couldn't do it anymore. A triple top is almost unheard of. We had a quadruple top over here, but just for a second till we had that breakout. Okay, that means that's going to go much higher. But in the physical only markets, that's this market, except that this is rarity. So this is where you might have an ounce of gold go for 15 million bucks. Who can afford that? The 1%. The guys that are driving this bus. That's who can afford that. And look, they had their breakout back in January of 2022. You think they might know something before you? And what are you looking at? Are you looking at the physical only market? Or are you looking at the spot market, which is easily manipulated? So what do you trust? Do you trust a contract that costs virtually nothing to recreate and make it appear like there's a whole bunch more gold and silver than frankly ever exists? Because when you're going into here, this is finite. Contracts, they're infinite. They can do as many of those as they want to. But what about silver? What's happening with spot silver? Well, here's the spot silver chart. Remember, we looked at it last week and we saw that wedge. And guess what? It broke above the wedge, right? So what happens when you suppress a price, you suppress a price, you suppress a price? When it shoots above in a wedge, like a piece of cheese, when it shoots above, the next most likely outcome is going to technically keep going up. But yet neither one of these actually indicates the true fundamental value of an ounce of gold or an ounce of silver. It's a flippin' bargain. But technically, you will see the spot market go higher. And what is our good friend Larry Summers, and I say that out with tongue in cheek because you know Larry Summers is not my favorite person. He had so much to do with allowing the derivative markets to expand and letting the banks take over. So he's not my favorite person, but hot jobs data, neutral Fed rate, much higher. What is the neutral rate? The neutral rate is the theoretical level for the Fed's benchmark that doesn't create inflation, it doesn't stimulate, or it doesn't restrain growth. It's just a theory. They don't know where it is. They think it's 2%, and hence they're pushing for that 2%. But the reality is it's probably much higher than there is no flipping neutral rate. I mean, give me a break. It's just what they like to say so that it makes you seem like they're doing something and they know something, but they have no idea. This was a hot report, the employment report, that suggested, if anything, the economy is re-accelerating. Well, if it re-accelerates, what does that exactly mean? That means more inflation. If there's more inflation, then in theory, the central bank really can't lower rates. In fact, if inflation goes higher, noticeably higher, because obviously all they've done is slowed down the price increase. They haven't eliminated it because that's not part of the plan. So what that really means is that they're going to have to raise rates. They can't lower them. What is that going to do to the entire market? Do you want to take that chance and not be prepared? I mean, you got to do what you're comfortable with, no matter who says anything, right? No matter what I say, I'm doing what I'm comfortable with. Food, water, energy, security, barterability, wealth preservation, community, and shelter. I got it done, and I'm not as done as I'd like to be. How about you? Where are you in this process? Because there's really no neutral rate. The goal for the central banks is to have inflation go down slow enough that you don't notice and you agree to stay put. That's what when they talk about price stability, it's on you. It's not that the price stays the same. It's that you don't make any changes to your lifestyle because of it. They still get your purchasing power. So let me tell you what you're looking at here. Remember how they keep talking about all these tight financial conditions? Well, this is from the Federal Reserve Education Department. They were only tight for a heartbeat of a minute in 2020. Below the line is looser conditions. Above the line is tighter conditions. Do you see it above that line very much? No. So and all of those looser conditions, what that really creates is more inflation. But this is probably the most important chart that I've been showing you. You guys know that I've talked about the fact that when this turns up in a pervasive way, then I'm going to say that we have started the hyperinflation. And you can see, I've shown you that it is up in a pervasive way. Now look, I can't guarantee this, but I've been doing this on some level since I was 10 years old. It is in my DNA. And this is, maybe I'm wrong. And frankly, I hope I am, but I don't think I am because the system must reset. It's too convoluted. It's full of too much garbage. And when you see the times that the money changes hands moving up in that way, quite frankly, why are these hot numbers a surprise? It's ridiculous. This is their data. It's not my data. It's their data. You got loose conditions and people spending money really fast. That's inflationary. That's all inflationary. So I think it's always funny when they say, well, this is a surprise. Well, wow, we haven't seen this before. This is all repeatable patterns. They have seen it before, just not in this cycle. And remember, when you're talking about life cycles, everything has a life cycle. I don't look like my 9-year-old granddaughter or my 11-year-old grandson. We're at different points in our life cycles, and currencies are absolutely no different. There's virtually and officially no purchasing power left. It's just your confidence that is holding all of this together. So when that confidence goes away, and by the way, the 2 and 10-year treasuries have been inverted for the longest time in history. The other time when they were as we were making this transition, right, into a new system. But now it's the longest that it's ever been. A little blip here, a little blip there, a little blip there. And gosh, remember these gray bars that you see on these charts? That indicates official recessions. So if they don't call it, we're not in a recession. But I can tell you that there are people that are still in a recession from what happened back in 2008. They haven't recouped from it, and let alone from 2020. So I take this very, very seriously. And what this indicates to me, since this is the longest inversion in history, and they want you to think, it doesn't matter anymore. That's garbage. It's absolute garbage. Don't believe them because their job is to lie to you. That tells me that what we have coming up is going to be worse than what we've ever seen in our lifetimes for sure. And it is, because this is a digital revolution. Are you ready for this? Because that was the start. This is the end. Do you have food, water, energy, security, barterability, wealth preservation, community, and shelter? If you don't, it is so critically important for you to come together in local community and find those other like-minded people or people with different skill sets, your neighbors, people at the farmer's market that grow your food. You need to urgently get to know your neighbors and get to create your local community that can come together and help you survive this. Globally, come together, and here's this quiet revolution. Imagine buying gold and silver, that's all you have to do. This is a peaceful revolution. You are making your stand because we vote with our wallets, we vote with our purses. So if you buy sound money, we got a shot. If there's enough of us doing this, we've got a shot at having a voice on the table, and we need that. Because what we're looking at is the Citi Global Economic Surprise Index. And guess what? That's up to a pretty high level. Do you think with all of these shifts, pattern shifts, and the decoupling of synchronized markets that are no longer synchronized central banks that are no longer synchronized? What do you think? Is it a possibility that something could happen and shock the whole system? Are you ready for that? I'm ready, and I'm ready to be here and be of service. So if you like this, please, again, give us a thumbs up, leave us a comment. These things help the algorithm grab it and show it to more people. Share, share, share. This is a very important video because of all these pattern shifts that are happening. That tells you that this trend in a negative way is evolving, and we are in a very fragile circumstance, and things can change very rapidly, as you're seeing. What are you going to do about it? Join the community and help us. And make sure that you send your questions to questions@LynetteZang.com. And don't forget, if you haven't watched it yet, a big part of the strategy is accumulating this right now and then converting it into income producing assets on the other side of it. So I did the video last week, Saturday, for gold and real estate during hyperinflation. I also had a great interview with Chris Rice on Rice TV X, and don't miss that one either. All the links are below. And for GWiz Weekends, we talked about how HSBC's 80% profit plunge. What does that mean? Because the banks are the method that the central banks deliver their policy to the public. So what is that telling us? We talked about that. And every Tuesday at 10 a.m. Pacific Standard Time and 1 p.m. Eastern Standard Time, I'm on live and I take Q&As. And I'm going to tell you, because I just put it on the calendar this morning, and I don't even usually do that. Jacqueline usually handles it. But I had a great interview with my very good friend, Gregory Manarino. You'll see that interview on Saturday, so definitely stay tuned for that. But he's coming back on June 17th, so mark your calendars, and he's going to be on with me live. You're going to be able to ask him your questions then. I'm so excited. It was fabulous. So, look, this is all about building community. And I absolutely know that together we can make a positive difference. And we have to build the local community to help us survive this and the global community to have a voice. We can do this. We can absolutely do this. So until next we meet, please be safe out there. Bye-bye.